Uh, Good afternoon, everyone. We're thankful for you to be here with us today. It's another exciting one for us here at First Asset Management, another edition of our webinar series. And today's edition is going to be very, very interesting as usual. Thank you so much for making time. We know that you have a very, very busy schedule, so we'll try and make the most of the time we have with us today. Before I dive into the theme for today, by show of reactions, how many of us have received money, spent the money, and we can't even remember what you used the money for? By show of reactions. Okay, good, good, good. How many of us have done investments? We didn't even find out what the investment was about, and we got burnt. Good, good. We're getting more reactions. We're getting more. And lastly, how many of us, when we hear investments, we're thinking numbers, spreadsheets, calculations. I will just get tired. Fantastic, fantastic. This webinar is for you. Come to the front of the class. Come to the front of the class. This webinar is for you. Today's one is very interesting because it is themed maximizing the present, creating the future with your money. And my name is Muyiwa Lawal. I'm the team lead affluent client sales at First Asset Management. I won't be doing this alone. I have my very, very powerful colleagues on the call with me, and they will be sharing insights both from their personal and professional experience as to how you can create the future with your money today. I'll be going over to introduce each of my colleagues. Firstly, if investing was a journey and you don't want to be wandering around hoping for the best, then you should speak to Anne Oragwu, who is the head of investment advisory here at First Asset Management. Hello, Anne.
Hello, and hello, everyone. I'm excited to be here.
Thank you, thank you, thank you, thank you. Secondly, for our head of fixed income and emerging markets, fixed income, I mean, from everything to treasury bills, money market funds, commercial papers, she's always 2 steps ahead. Hello, Tutu. Tutu Owolabi-Kadiku is on the call with us as well. Hi, Tutu.
Hi, Muyiwa. Hi, everyone.
Lastly, the man who lives and breathes equities and ensuring our equity funds are performing well above benchmarks and across all the industries. Gbolahan Olagunro. Hello, Gbolahan.
Good afternoon, everyone. Thanks for the accolades, Muyiwa.
Thank you, thank you, thank you. We would have a Q&A session by the end of the program. So if you have any questions, any comments, please drop them in the Q&A box, and we would attend to as many as time permits us. Thank you once again, and we'll be getting straight into the matter of the day. And I'll be starting with Tutu. Hi, Tutu.
Hello, Muyiwa.
What would you say is the biggest psychological mistake people make with their money today? I mean, there are so many examples, but what would you say is the biggest psychological mistake?
Okay, hello, everyone again. We're truly, truly delighted to have you here today. Like Muyiwa said, I am Tutu, aka Double Two, for those that know me from our previous webinar.
Okay, I think Tutu is having issues with her network. Okay, while we wait for her to come back, let me jump straight to Anne. I mean, we'll come back to Tutu, but Anne, hi Anne. What financial habits would you say delivers the biggest long-term payoff?
Okay, good question. I'd say the one habit, the most important habit to me, is to pay yourself first. Was that Tutu?
Yes, I think she came back briefly. But Anne, please go ahead. Please go ahead.
Okay. The most important habit would be to pay yourself first. And what does this mean? This means that anytime you come into income, whether it's your monthly salary for salary earners, or if it's money you get from a contract, if you're a contractor, whatever source of money you have to put aside a portion of it for your future towards your goals before you start to pay everyone else. Before you pay the transporter, the petrol station, the school fees, rent, you have to pay yourself first, and it's essential. And the best way to do this is to automate this. And so
Perfect.
for some of us, we just do a direct debit. I think it's also called structured payment, where it's in, you've gone to your app and you set it up such that the first of the month or the 30th of the month, whatever date you've chosen, the money goes there. So you don't even need to think about it. It happens automatically. And
Correct.
guess what happens when you do that? When you do that, you will be forced to live with whatever is left. So please don't
Correct.
say, I will spend and at the back end I will save, because it doesn't work. I learned that the hard way about 10 years ago. My salary had come in. I took out a large chunk. Then I used to use cash for a lot of things. About 10 years ago, we didn't use cash for a lot of payments. I took out a large chunk for a purpose. And by the next day when I wanted to pay, the money was practically gone. And I was like, hold on, Anne. I started to think of all the little things here and there that I was doing, give
Exactly.
to this, give this person. And I was like, I can't live like this. And on that day, I took the decision that whenever I get money, I will pay myself first. Because your goals they have to be met. You can't work hard and you're not meeting any goals. So start off with paying yourself first. If that's the one thing you take away from Anne today, please take that as the truth, something you have to do. Thank you.
Thank you so much. And very, very interesting take. Pay yourself first, especially in this part of the world where there is something called black tax. So before you start paying that black tax, pay yourself first. Thank you so much, Anne. We'll
Absolutely.
double back to Tutu now. Tutu is back now. I'll repeat my question so that everyone can follow on. Tutu, you were going to share what you thought was the biggest psychological mistake people make today when it comes to money. Please go ahead.
Oh, can you hear me now? Am I audible? Yes.
Yes, you are. Yes, you are.
Okay, so I'll just go
Yes, you are.
straight into it. So the first one for me, like I mentioned, has to do with people spending based on emotions as opposed to logic. And I said
Mm,
better said than done,
mm.
right? Because I can paint a scenario, a point in my life where I thought I was really doing really well. I just got a new job. I just passed an exam that I was working very hard for, CFA to be precise, and I felt like I was doing well. But you know how it is when you get home and you start scrolling on Instagram, on Snapchat, and you just bump into people, secondary school or uni days, and someone just bought a car, another person is on vacation, another person maybe just got
Pressure,
promoted.
pressure.
Pressure, and you start to feel like, okay, you're not measuring up. I mean, for me, the trigger then was to spend. Like I would just spend to try and fill that void, right? Spending maybe money that I had saved towards a particular goal to please people that did not even matter, or money that I did not even have on things that I didn't really need, right? So that's a trap or a psychological mistake, trying to fill a void. So spending being driven by emotions. Another one
Mm,
that comes to mind quickly, meanwhile, something called lifestyle inflation. I know, lifestyle inflation. Nothing much to it. What it means is that for every time your income increases, you feel the need to let them know that you have arrived. I don't know if
yes,
anyone can
so
tell that levels have changed. So it's a situation to measure up. A good example would be a scenario where you were earning 150,000 every month and you were just fine with the 150,000.
mm,
Then
mm.
finally, that promotion that you have been going for arrived, and they increased your money to 300,000. Rather than saving that excess, you find that people begin to remember, oh, now I think I need to upgrade my phone. Oh, this
Yes,
shirt
so
doesn't quite as nice. Oh, this. So that's what lifestyle inflation is, when you feel the need to always measure up every time your income changes. And then finally, quickly for me, which is most important to me, I mean, if you didn't get anything from what I've said so far, for me, the biggest one, undoubtedly, right, is when people tend to think very short term in a long term game. Thinking very short term in a long term game. And what do I mean by that quickly? I just want to ask the audience a quick question. If I offered you 10 million naira now, as opposed to offering you 100 million naira 10 years down the line. In fact, Muyiwa, which one are you going to take? Which one would you take? 10
oh,
million
but
now
that 10
or
million
100
now,
million?
run me the 10 million now. Run me the 10 million.
Okay, yeah, and there's really nothing in taking 10 million. Honestly, there's nothing wrong with taking 10 million. But Muyiwa, realizing the problem. Because by taking that 10 million, what we have done is we've traded tomorrow's freedom for today's gratification. Because at the end of the day, we're human beings and we want that quick win, right? And what you've done invariably is by doing that, you have viewed, listen to this, you viewed money as a reward, not a tool. The key thing here is we must understand on this call that money is not a reward. Because when you had 10 million, you were thinking reward is money that's not mine. Money is a tool, right? So when we look at money as a tool, we're able to really use that money, but we are able to empower it to work for us. We want the money to work as hard as we're working, right? So to just drive home the point and to make it very simple quickly, I know I've taken so much time, is assuming you had 50K that you put in a money market fund every month. Let's assume you were earning about 12% over a 30 years period, right? At the end of 30 years, you will have contributed about, I would say 17 to 18 million. But time contributes about 150 million. And that's just the power of understanding that you need to be in the game for the long run. You need to understand that money is a tool. It's not a reward, right? So for me, that is the biggest most people make. Being short-sighted, not being able to take advantage of the compounding impacts of investing over the long run. And that money is a tool. Thank you. I hope I've answered the question.
In fact, you have done so much justice to the question. And I'm so happy because our listeners are in for a treat. We're dropping gems, we're breaking myths, and we're also making them understand the power of compounding. Gbolahan, over to you.
Yeah, I'm with you.
Share your thoughts around one myth about wealth building that needs to die. Yeah, I have one in my mind, but let's hear from you.
I believe I'm going to say your mind. So for me, the biggest myth would be the misconception that you need a high source of income to be able to build wealth. I think that is a misconception that holds little or no substance. Now, to explain this to you, I acknowledge that yes, if you have, a good source of income, it would certainly help you, give you a sort of strong start in building your wealth. But that does not necessarily, help in building wealth over the long term. So you need to understand that wealth is actually derived by that gap that exists between what you earn and what you spend. And then more importantly, what you're able to do with that gap over time. Now, look, I've said two things. One is the gap between what you earn and what you spend. Then secondly, what you're able to do with that gap over time. Now, to illustrate the first point, the gap between what you earn and what you spend is simply savings. Now, you can have two individuals. I'll use my fellow panelists, Anne and Tutu. Anne earns 100,000 naira in a month. Tutu, on the other hand, earns 200,000 in a single month. If in that month, Tutu is able to save just 20,000 out of her 200,000, and on the other hand, of her 100,000, she is able to save, let's say, 40,000. So what you realize is Tutu is a higher income earner relative to Anne, right? She earns 200,000, but she was able to save just 20,000 lesser than Tutu, who earns a lower source of income. So that's to make you realize that it's more about what you're able to do with that gap between what you earn and what you spend. So discipline in spending pattern is very, very important for you to be able to build wealth over time. So you've got to be disciplined about your spending pattern. And I think Tutu mentioned this earlier regarding lifestyle inflation. So ensuring that your lifestyle does not grow at the same pace with the growth in your income. The moment people experience a small or substantial increase in their income, they're thinking about, improving their spending pattern, getting new wares, getting new clothes. But you also have to match that or find a balance between maintaining that gap over time, which is where savings comes in, and then more importantly, channeling that savings into investment. So I think this is one area where people also get it wrong. People tend to save over time, leave their savings in bank, but unfortunately, you're not maximizing your savings. So the way to maximize your savings and ensuring that those savings ultimately translate into wealth in the long term is by channeling those savings into investments.
Thank you so much, Gbolahan. I mean, that's the myth I had in mind. I mean, you hear people today saying, oh, but I don't have 10 million now. I don't have 50 million. We actually have mutual fund products that you can invest with as little as 5,000 naira. So it starts today. And I need to share these comments in the chat box. You've seen somebody knows you well here. They said your net worth is actually around $100,000. No, 100,000 naira.
That was just an illustration. And
very
please let's take
interesting.
that
Explain
pass
it
it on.
fully.
And spread the love, spread the love. Give us the secret.
Okay, quickly, I'm really enjoying how the conversation is going. So I'm going to throw this question to everyone, in terms of your personal experience, in terms of your professional experience. What's the smartest financial decision you have ever made? And you can go first, please.
So the smartest financial decision I've made has been to invest when I thought I wasn't ready. And so I'm fortunate to have a colleague who's very interested in my welfare. And she came with an opportunity for me to invest in a way that would diversify me against across currencies, because it was a pounds investment, and across regions. And I thought to myself, I can't afford this. And the first time she told me, I just ignored it. She came back about a year later and was like, Anne, how's it going with that investment? I told you who to speak to. I've done the first batch. I'm now going into my second property. And I was like, we're colleagues. I couldn't afford the first one a year ago, and you are going into the second property. So I was just sitting down there confused after speaking to her. And my husband came and was like, what's going on? What's going on? I had the product on my screen, and he was like, this looks very good. I think you should do it. I said, but I don't have the money. And he was like, well, what do you have? What do you have? And so I was like, well, I have shares. We went on, we looked at each other like, okay, my shares have grown on. Not too bad. I was like, well, I have some mutual funds. I looked at different things, and suddenly I realized that because of fear, I just thought, no, it's in pounds, blah, blah. I can't afford it. At the end of the day, I was able to invest, and I was still able to keep my investments in Nigeria, because by the time I sold some shares, I did some things, moved things around, and I diversified. That has been my best decision ever. Diversified around across regions, currencies, and every month when I see the returns, I just smile to myself. But to be honest, if you had left me, I'd have just sat down there and said, I don't have the money. And one important thing I need to point out is we need to take opportunities to invest in assets, not liabilities. Because I know some of my sisters, not naming names, they will scrape all this money, but it's to buy a bag. It's not to buy something that can give you returns. I'm not saying you buy the bag, but let's start with investing in assets. And then the returns from those assets we can use to buy other things. Thank you.
Thank you so much, Anne. I think Suzu can go next. Yeah.
Okay. Okay. As a respected fund manager within the industry, I'm sure a lot of people will be thinking maybe an investment in stocks, an investment in bonds or exotics or derivatives, right? But undoubtedly, the highest yielding asset in my portfolio, the smartest financial decision I've ever made, is an investment in myself, right? Because I realized very early in my career, right, that money always follows decisions, right? And decisions always follow knowledge. So for me, undoubtedly, the smartest decision I ever make and will continue to make. It's like a plant that as long as you keep watering and nurturing it, it continues to produce fruits beyond expectation, right? So when I found out about this, I decided that I was going to be a student of money, right? Because I knew that if I wanted my money to grow, I had to be someone that was knowledgeable. I had to be someone that could add value. I had to be someone that could make an impact, right? Because I knew at the end of the day, knowledge could never be taken from me. So I started investing more in my capabilities. And how did I do this? I started reading books. I started attending webinars like we're doing today, right? I started following certain investors in the market. I made mistakes. I learned from my mistakes. And I found that as time went by, I was good at it, yes. So that even encouraged me to go further, right? And I'm not a trust fund baby, right? I wasn't born with a silver spoon. So I understood very early in my career that I didn't have the financial muscle to really invest aggressively. But I knew that invested in my own capabilities that would create value for me, would attract the kind of financial capital I need. Now, I'm not saying that we shouldn't start investing now, but I'm saying when you have scarce resources, you need to channel it into something that will yield that fruit. And for me, it was an investment in myself. And I say this because taking the Nigerian context, I know we like to party, we like to upgrade our phones, we like to go out, and there's nothing wrong with that. But if I was even going to throw this question to members of the audience, how many people have consciously taken an effort to buy an investment book, taking an effort to take a course in finance, right? These things might seem like they don't matter, but you'll be surprised how just one webinar that you attended can introduce a concept that can really change the way you manage your finances, right? Just reading a book can just change the narrative of how you manage your finances, like I said earlier. So what I would say definitely, right, is an investment in self is the biggest one I have made, right? Because even doing that, I'm sharing this with you because even doing that, I've learned in the course of that successful investing doesn't have anything to do about knowing everything, right? It's about even knowing when to leverage on the expertise of others, knowing where you can't know it all as an individual. You have to learn to leverage on the expertise of others, which is where we come in even as first asset management, because you have time doing the things you do, allow the expert to manage your funds, right? And then quickly for me, Muyiwa, finally, is the fact that people also need to understand. I know you asked me the smartest decision, and it just shows to prove how an investment in self can continue to compound and compound and give you returns. The last one has to do with why do people want money, right? I also found out very early in my career, like, why do people want money? You need to understand the why, because when you understand, for me, really, money was not the destination. Money, freedom for me was the destination. I wanted to be free, right? For me, money was freedom. Money was a choice. Money is security. Money is having the ability to leave my job when I'm tired of it, right? Money is the power to retire with dignity. So once you understand the why behind those decisions, it allows you to make those investments, those sacrifices required to move to the next level, right? So for me, undoubtedly, it's an investment itself. It's not about the return on investment, because at first asset management, when it comes to investments that have gone right, trust me, we've had a lot of profitable investments. Is that investment in self really that turned me into someone that was able to recognize a good one when I saw that in the market? Because at the end of the day, the market will change, interest rates will change, government will change, but I believe that that asset investment itself will keep giving, because the more I did that, the more my money performed. And remember, I told you freedom is my own objective. So the more I grew to that. So that's it in a nutshell. Sorry if I've said too much, but investment itself my mind in terms of what you need to do to really get there.
Not at all. In fact, I'm seeing comments. You have fans in the comment section. You're getting fans, so don't apologize for sharing these gems. GB, what would you say is one of those financial decisions you've made?
Yeah, I mean, I would want to rehash what Tutu has said, but for me, the smartest decision I made was, I think, commencing investment in the stock market at a very early stage of my career. So I started off as a research analyst, and then while I was a research analyst, I would typically go to the trading room, to speak with the brokers on the recommendations I've shared on stocks to buy, stocks to hold, stocks to sell. And so there was this fateful day that a broker told me he received a substantial amount of money as dividends from companies invested in GT, Zenith, and he said he was able to put all of those funds together and it would go into, the purchase of his vehicle. And I was amazed, like, oh, seriously? Dividends from those companies. And since then, I took particular interest in understanding the stock market, drivers of the stock market, drivers of values for companies in the stock market. And that's how I was able to sort of progress in my career to a portfolio manager, to the managing equity-based funds for first asset management. So in the early stage of my career, I learned about, I think, the power of compounding. And if I look at my portfolio today, I can't be more proud about, some of those investments I made. I think for the sake of, just probably also stating it, my GT Co, the first purchase was around 25 Naira, Zenith was around 24 Naira, MTN around 169 Naira. And if you look at
I said I said he lives and breathes equity. He's
I
showing it now. I
remember.
said it.
So if you look at where those stocks are trading today, I mean, that just goes to show that if you're able to start early enough, more importantly, remain consistent with your investment. So again, one beauty about investing either in a mutual fund, smart beta equity fund, or balanced fund with first asset management is you would also earn returns on an annual basis. So rather than
Yeah,
also
and
spending those
dividends.
returns that are distributed to you, you can actually what reinvest it to be able to double up on the impact of the power of compounding. So for me as well, as I got dividends from companies, rather than spending those dividends, I also what reinvested those dividends in improving my unit holding across all of those companies. So for me, I would say that early exposure to stock market investing has actually helped me in laying a very strong foundation at the early stage of my career. And what I'm pretty much doing now is just optimizing my investments, diversifying into more profitable companies where I see opportunities.
Thank you so much, everyone. Now, just to recap, I mean, Anne shared with us um, how the smartest financial decision she made was to invest even when she was not ready, right? Because, I mean, if you want to be ready, you will never be ready. So just start. Tutu said I mean, the best decision she made was investing in herself. I mean, and that got me thinking, like, have I invested enough in myself? Let me go and do more. Let me go and do more. And with GB, I mean, starting early in the equities markets, I mean, it's he's reaping the dividends now. I mean, many years ago, and he's still reaping the dividends. So thank you so much, guys. I just wanted to reiterate for our attendees, please drop your questions in the Q&A box, not in the chat room, so that we can pick them and answer as many as we can. I mean, the comment section is a bit muddled up. So for if you have questions pertaining to the webinar itself, drop it in the Q&A section or the Q&A box rather, and then we'll attend to them as much as we can come the end of the webinar. Staying with you, GB, because you said something about early investing early in life. I mean, you're a young dude. Investing early in your career might not have been that easy. So that means you had to sacrifice some form of enjoyment, right? To invest that early in your career. So, and many people believe today that um, building wealth means sacrificing enjoyments, right? Is that necessarily true?
Yeah, I don't think it's entirely true. So the point is not to deprive yourself of the essential things of life, good
Yes.
food, shelter,
Yes.
clothing, I mean, good accommodation for yourself. But the point is having a disciplined spending culture and be consistent with your savings as well. So I'm not saying you should now spend or you should decide to save all your income and deprive yourself of, I
Mm,
mean, a good quality life. Because again,
yeah.
if you invest today and you don't take good care of yourself, then ultimately it means that so that person may not be alive to be able to reap, I mean, the gains from those investments, and it's going to be the
Exactly.
case of
Exactly.
all the next of kin you've been putting in place in all your series of investment that will ultimately reap the benefits. So we all want to reap, I mean, the gains from our investment activities. But the point is finding that fine balance between, I mean, those responsibilities are what you spend on the essentials of life, family members, other
True.
obligations that you have, and ultimately ensuring that you are still able to save a reasonable amount of out of your income, and more importantly, remaining consistent with that savings pattern. Another important point to notice, I mean, there are also a few things you also need to be mindful about. So, as you also strive in maintaining that fine balance, it's also important that you avoid excessive debt. So that is also a factor that
Mm,
could also
mm,
ruin, I mean, your savings in the longer term. So avoid
true.
excessive buildup of debt. If at all you're
True.
going to take debt, ensure that you take debt that would create valuable assets that are capable of also generating income streams for you in the future. So if you can also take debt today, I mean, to invest in our funds, in the smart beta fund, the balance fund, to be able to earn returns and use part of those returns in paying back your debt. But again, you also need to be aware about, I mean, the risk inherent in investment before, I mean, using loan as a source of finance in order to grow, I mean, your investment. So I think with those two key points, I think people should get a fair sense of the fact that you don't necessarily have to deprive yourself of, a good quality life. It's all about finding that fine balance between what you spend on and ultimately ensuring.
Am I audible? Okay, because I lost GB for a second there.
Okay, can you hear me now?
Yes, I can. Yes, I can now. Okay. Okay. Thank you so much, GB. Just to add to that, I like what you said about not being necessarily sacrificing enjoyment, quote unquote. For us here at First Asset Management, we advise spreading your income across your needs, your wants, and your savings, right? Just your needs such as housing, food, shelter, and then your wants, because really you can't avoid, a night out with your significant other or taking your kids out for lunch and whatnot. So don't deprive yourself of that because you're trying to create wealth. You should split your income across those three things and just be disciplined with the last part, which is your savings and investments. Thank you so much, Didi. Um, okay, we're getting more questions. We will be taking them at the end of the webinar. Just keep sending them, keep sending them, keep sending them. Moving on to Tutu, right? GB has told us that we don't need to sacrifice enjoyment to create wealth, and I'm happy. I'm at peace. In terms of spending, right? How would you distinguish spending that genuinely improves your quality of life and spending that is simply driven by lifestyle inflation or social pressure? How would you distinguish between both of them?
Wow. Okay, this is a tough one.
Honestly, it sounds like a lot, but you are capable.
I know. Honestly, I'm in no position to tell people how to spend money that they've really worked hard to earn, particularly because we're different individuals with different desires, different needs, and different goals, right? Nonetheless, I would say your key ask is to try and distinguish on what can be considered good and bad investing, which is also very tricky. For double two, right? The best spending for me is spending that improves your life, right? It is spending not aimed at impressing people, right? It is spending that continues to create lasting value, not temporary validation, right? And for me, it's not about how expensive or cheap an item is, right? It's not about luxury or modesty. For me, it's about value versus validation. And I'll give an example, right? I know we have some Ronaldo and Messi fans in the house, and I'm going to go there on this call, right? Assuming you had,
tread carefully.
The World Cup is on now. Let me bring it on. So assuming you had two individuals, right? Let's use Ronaldo and Messi, right? Ronaldo, right, decided they bought the same car, right? The reason why Ronaldo bought that car was because his family had expanded. They had triplets for some reason, and there's a need for a new car for safety and reliability. And they were going to use that car for about 8 years. For me, that improves the quality of life of that particular family, as a Ronaldo fan, of course. But now let's imagine Messi. Messi bought the same car, right? Why did Messi buy the car? He bought the car because everybody in his league also bought the same car. Or let me say everybody within that particular threshold bought that car. 6 months down the line, the excitement is gone. And trust me, that happens to most of us. You want to buy something, it's shocking you, but after a while, it just fizzles away, right?
Yeah.
Same car, Muyiwa, different psychology, different outcomes. Now, print another scenario, right? Just to drive on the point of two parents that spent 50 million naira, right? One parent spent that money on a lavish first birthday party for a child that they've been looking for 10 years, right? It was the talk of town, Instagram, comments and likes, right? They have another parent that took that same 50 million naira, they converted it into USD and invested it in our first specialized dollar fund, right? That particular fund is a dollar-denominated fund that in 2023 did 10%, 2024, 9.4%, 2025, 8.86% in USD.
Can you beat that?
Just to invest in the future of their child. I guess the question I'm expecting from the audience is, which one is good and which one is bad? My response to you is none of them is bad. Why? Because one spent money to create a memory. This is funds that they have been saving, right? They didn't draw into their emergency fund. They didn't spend money that they did not have. It's something that they were very intentional about. And it created a memory that they will treasure for life. On the other hand, the other person decided to create a future for their child in terms of an investment. So to me, neither is wrong. But overall, what is quite important to me is the value it adds. You find out that something that good spending continues to add value, right? And just to wrap up quickly, for people to be able to differentiate between this, I'll just add a few nuggets that I've learned in the course of my career. The question is, would this spending improve my life, not my lifestyle? If the answer is a yes, please, it's good spending. Does it align with my intentions, or I am reacting to pressure? Think about it. Will this improve my financial future, or does it weaken it? Think about it. Am I doing this so that they will notice me and know that I have arrived? Well, I guess the answer is this. You know what is good from what is really bad at the end of the day. And I just want to say that I have been privileged to meet quite a number of people, but for me, the richest people that I've been fortunate to meet are not always those with the flashy cars, right? The big houses. They are people who have the power to make choices, the power to walk from a job that they are no longer interested in, right? Power to retire with dignity, to pay school fees without anxiety, right? People that are prepared to take opportunities because they're able to take the opportunity. Another question is, we have new IPOs coming into the market too. Something is happening in Q3, something is happening in Q4. Are you ready? For me, that is good spending. That is good spending. So in conclusion, good spending does not involve trying to impress people, because luxury comes with having that peace that your future is secured. For me, that is what I determine as, well, that's what I would say is good spending. That's the best spending. Again, I stand corrected. We're still learning. Thank you.
Yes, we're still learning. We're still learning. I mean, Tutu, you did so much justice to that question. And we're still learning because some people have drawn comments here saying, who memory helps? So some people are not necessarily concerned about creating memories. They are more concerned about saving money, which is good, saving and investing the money, right? So all of us are still learning. I mean, but sharing this insight has helped me, and I hope the attending understand that money is about the value it provides, right? Not necessarily about if you are buying something that is expensive or affordable or cheap or quality. Is about the actual value it provides. Thank you so much, Tutu. Hi, Anne. This question is going to you. Tutu has spoken about how you can distinguish spending that improves your life and societal pressure. For beginners, because beginners are the ones that experience the most pressure, right, when it comes to investing. How should they choose to go about starting their investment journey? And what does a healthy investment balance look like for beginners?
Okay. So since the emphasis is on beginners, the first thing I would point out is it's important to seek information. And I think Tutu spoke about that, the importance of equipping yourself. And it could take time to get to a level of expertise where you can make sound choices. So you can also go to experts. You can go to any of my colleagues in First Asset Management or any renowned financial institution to give you advice on what to do. Because it's very important that you don't get burnt a lot when you just start, right? So that you don't get scared. The next most important thing is to start today. I saw in the comments someone saying investments are nice when you have something to spare. If you started from the beginning of this session, you remember that I mentioned the fact that you need to pay yourself first. So your investment is not what you have to spare. Your investment is the necessity as long as you're earning money. So start today with what you have, right? We have mutual funds, the money market fund, the halal fund that starts with 5,000 naira. Most of the people on this call can afford 5,000 naira. We have the dollar fund that starts with $100. At least a decent number of people, participants in this call, can start with $100. So please don't wait till tomorrow. Start today as a beginner. The next thing is it's important to match every naira with its purpose. So whatever monies you're receiving today, is it your salary? Even in school, is it your pocket money? Because right from school, I was a beginner in school. That's when I started to save and invest. What is the purpose? determine which one is for the short term. That's your everyday taking yourself around, feeding, blah, blah, anything 1 year and below, even things like rent will fall in. And for parents, school fees, that necessity that you can't avoid, which is for the short term, which is for the medium term, 1 to 3 years. Maybe I want to buy a property. What are the things I need to do? I want to go and improve myself, like Tutu spoke about. I want to go for a master's somewhere, but I can't do it this year. I'm saving for the future. And then which one is the long term for, your real future? Some of us saving towards retirement. And the truth is, everybody should be saving towards retirement.
Towards
If you start
retirement, sure.
from the first day you start working, you retire so well, right?
Yeah.
So you need to put your purpose to every naira you earn. And then think to yourself, how much time do I have for all of these things? So put them in buckets and see, okay, I have this amount of time for this. How much risk can I take if, the value of this investment drops? Will I be able to sleep at night? And so you need to put your monies in those buckets. Like I said, not by yourself or you're a beginner. You're going to work with a financial advisor, please.
Yeah.
You might be very smart. I know a lot of people here, first class score, but experience helps.
Yes.
Experience helps. So, like I said, first start now, identify, match every naira with its purpose, whether it's tenure, whether it's risk, and make sure that you are consistent. Because the key to ensuring you have a good financial future is truly consistency.
Yes.
Even if you're saving a little amount, even if you start with that 5,000 naira, it pays over time. So please, let's run with those. Start now, work with knowledgeable people, be consistent, and match your naira with its purpose. Thank you.
Thank you so much. And I mean, you're also having found so many comments for you based on what you just said. So basically, first of all, consulting an expert. And I mean, I'm not overflowing the issue when I say here at First Asset Management, we have loads of them. Whether you're in the US, Canada, UK, Nigeria, Abuja, Port Harcourt, we can reach you and then take you through this investment journey. So yeah, consult an investment advisor, start today, match every naira with a purpose, and last but not the least, you have to be consistent and disciplined. Very, very important because the investment advisor is not going to do that for you. You have to do that for yourself. So thank you so much, Anne. I'll be jumping to GB now, and oh, sorry, Tutu before GB. Sorry, so sorry. I mean, Anne has already mentioned how beginners can structure their journey into different phases. So by setting short-term goals, medium-term goals, long-term goals. When setting financial goals, how can they create milestones that are both realistic, achievable, and motivating? Because for some certain people, right, everyone wants to create wealth. Some people have a number in mind. I want to be a billionaire by the time I'm 35, right? Which is possible, right? But this goal has to be realistic, achievable, and motivating. So how can they go about creating these milestones and maintaining the SMART goals as we all know? Hi, Tutu, can you hear us?
Unfortunately, I have connectivity issues, but I'm back now.
Okay.
Oh, okay. Did you get my question? Should I repeat my question?
Apologies, honestly, I did not get it.
Oh, okay. So I'll repeat my question. We're talking about setting financial goals.
Okay.
Anne had already mentioned in her response that for beginners, it's best to structure your goals in the short, medium, and long term, right?
Okay.
So in setting those goals, how can they also create milestones that are both realistic, achievable, and motivating? Because we have people that will say, "Oh, I want to have a billion by 2030," right? Which is possible, but is that realistic? Is it achievable? Is it motivating? How can they make it such that it's achievable, realistic, and motivating?
Okay, so because of my internet, I'm not going to turn on my camera. So let me just fire on. I'm trying to make milestones
Okay.
realistic, achievable, and motivating.
Yeah.
Honestly, but to me, I just feel like people need to stop falling in love with the destination.
Mm.
Imbibing the qualities of the person that would achieve that milestone, right? And things like you hear, I want, especially when it's a new year, right? Everybody's happy, new year, new resolutions. You start
Facts.
setting all the milestones, right?
We've
So
all been
people can
there.
say, exactly, you can say, I want to have 5 million at the end of the year, but they never really ask, what habits do I need to change to get me there? You hear some people also say they want to retire comfortably, but they don't ask, what kind of financial behaviors do I need to exhibit, right? Because for me, realistic goals for me, it's not really about the numbers, right? It's really about the
Mm.
behavior, right?
Mm.
That is
Mm.
what would help you get to where you need to go to. Because a lot of people were taught to set financial goals in a wrong way. Because we set financial goals that excite us. Like on day one, you are pumped, everything is about to move, but you haven't been quite deliberate around it, right? You
Road
say,
to
I
100
want to,
million.
yes, I want a million, I want to be as rich as Dangote. How? How will you be as rich as Dangote? You're just starting today. Do you understand what I'm saying? So
Yeah.
it's really people having the the resolution to really change the behaviors that will get them to where they need to get to, right? And a simple scenario could be someone that said they want to get to 5 million at the end of the year. There's nothing wrong with that. And believe me, we're all still going through this, easier said than done. And you create
Yeah.
a vision board that you look at every single day that says, I need to get to 5 million every single day. On the other hand, the more proactive step to take is, okay, I want to get to 5 million at the end of the day. How much do I need
Mm.
to invest every month, right? Am I spending intentionally? We've spoken about this. How
Yeah.
regularly are you reviewing your finances? If it's at the end of every month or every quarter, your outflows versus your inflows. And then what kind of decisions are you making based on emotions? So when you evaluate those things, you find out that you're able to get to that objective quicker because your behavior, your habits align with what you're trying to achieve, right? And then just to help people out, because you cannot ask me this question without maybe providing a solution that could help. Something I called PAT, but I guess I could just try and break it down. It has to do with the fact that you need to understand the rationale, the why. What's the purpose you're setting that goal for? You find that progress creates motivation. When there's a purpose around something,
Mm.
it drives you to be a bit more intentional about it. I want to save 5 million because I don't want to live in this state anymore. It drives you better because I want to pay school fees.
True.
Because I want to
True.
ensure that I retire early. So when you have that purpose at the back of your mind, it helps you to set those goals better. The second thing I want to ask quickly is actions, right? People need to take actions. You can say something, like they say, love is an action word. You need to implement, you need to move. You can't just stay at the vision board, like I said, every month. You need to be deliberate around things you want to do to change the
Mm.
narrative. The second thing I also wanted to add in that acronym, which is PATH. So we've done PA. For T, also be kind to yourself, give yourself grace, right? I know big dreams, but realistic timelines is very important. You have to be very realistic around your timeline. Rather than say you want to be a millionaire, you can say, okay, I want to increase my wealth by 10%. You want to say, how much did I save last year? How much do I want that to grow this year? If it's 15 or if it's 20%. So realistic timelines is something that is important. And then finally, for me, what I'm very passionate about is hope, which is the H in the part phrase. You have to celebrate your progress. It's very important because at the end of the day, progress helps us to get to that finish line. Nobody climbs a mountain in with one giant step, right? It's one step at a time, one step at a time, and you need to
Mm.
celebrate it. I imagine a time when I was trying to lose a particular kg. I'm not going to reveal that here, right? For every single time I lost one, I celebrated it. Same is
Yeah.
with
Yeah.
investment, is about the same thing.
Yeah.
Every milestone should be celebrated. Your first
Yeah.
100,000, celebrate it. First 1 million, celebrate it. First opportunity of investing consistently over 1 year, please celebrate it because progress is motivating. Small
Yeah.
wins should be celebrated, right? Just to create that confidence to enable us get to where we're going. So, in closing, for me, really, it's really being that person that wants things to happen, is really implementing that part phrase that I just introduced, right? And don't make your goals so big that they discourage you. It's very important to keep it very, very short and to celebrate them. Because at the end of the day, right, financial freedom is not achieved with one big goal. It's one small decision, one step at a time. So that's what I'll add. Thank you, Miwa.
Thank you so much, Tutu. I mean, even me, I'm even learning new things today. Path, purpose, actions, timelines, hope. I mean, so in terms of creating milestones that are realistic, you need to start with purpose. I mean, there's no point starting a journey and not understanding what you're trying to achieve on your journey. Taking action, setting timelines that are realistic, and then hope, celebrating yourself. I have something to share in terms of hope. I have a client that her son just turned 18, and he opened a money market fund account with us, right? He started with a sum of 40,000 naira, right? And he sees how the daily accruals happen on the mobile app on a daily basis, and he celebrates it. I mean, so if an 18-year-old boy has started his own investment journey with our money market fund, I mean, what are you waiting for, really? What are you waiting for? Thank you so much to Tutu. GB, I mean, we've shared our takes on creating milestones that are realistic, achievable, and motivating. There are attendees on this call who are at different stages in their careers, in their businesses, in their personal lives, from graduate trainees to startups, to middle to senior level management, people that are close to retirement, executives, directors. How should their financial roadmap evolve as they move through different stages of life? How do you think it should evolve?
Yeah, Muyiwa, thank you for that. So I'll just give, a sort of part that would cater for the different categories of people that we have on this
Another
call
part.
today. So for everyone generally, I mean, there are three things you need to bear in mind as you evolve in your financial journey. One, your key priorities. Secondly, your key responsibilities. And thirdly, which is also very, very important, is your time horizon during your financial journey. So firstly, in terms of, your responsibilities or your key priorities, that basically speaks to, what are the things you should prioritize at that point during your financial journey. So for instance, for someone in his early 20s, what you should prioritize at that point is investment in yourself. So personal development and growth. So
Correct.
investing in yourself, reading books, taking courses, professional exams that will add value to you. And why is this important? As you progress in your financial journey, when you get to your 30s, your ability to increase the proportion of your income that you can save, it will be dependent on how you have been able to develop yourself in your 20s. So for you to be able to increase your savings contribution in your 30s, it means your income has to increase. And that income earning capacity is also directly related to how much you've invested in yourself. So in your 20s, I would say focus on learning, personal
Yep.
development, and
Yep.
also ensure that you're able to what? Save consistently, no matter how
Yep.
small it is. Now, as you progress in your financial journey when you get to your 30s, what should you focus on? The key here is accelerating wealth creation. Now, to accelerate your wealth creation, it means the proportion of your income that you save has to increase. And unfortunately, at that point, you have to contend with what I would call a natural devil, and that is family responsibilities, because you're in your 30s, you're most likely going to be raising a family. So it's important at that point in time to learn how to sort of strike a balance between maintaining those family responsibilities, at the same time ensuring that those responsibilities do not hinder you from what? Savings. It's also important that in your 30s, you need to be very strategic with the kind of investment you do, because
Yep.
down the line, the level of risk you're able to take in your 30s will be very
Will
much different
reduce.
from the level of risk you're able to
Yes.
take in your 50s. And for instance, for someone who is invested in the stock market, in your 30s, if a stock declines by 10, 20%, 30% in a single month, you are likely to be able to withstand that shock. But as you progress in your 50s, it's unlikely that you are able to absorb that same level of shock. So it means that
Yes.
in your 30s, as you also gear towards accumulation of wealth, you also need to be very strategic. And being strategic means you need to increase your risk appetite. I know people always want to, to have it safe. You want to just invest and you get a guaranteed sum of money. But evidence has shown that the most successful investors in the world today are those who have some level of investment to the stock market. And to that extent, I would say in your 30s, acquisition of strategic assets should be largely skewed towards high risk assets so that as you progress to say your 50s, you can now begin to what unwind some of those gains from high
Yeah.
risk assets and now begin to what diversify into lower risk assets once you
Right.
approach retirement age. So in your
Yeah.
40s as well, another important thing you need to take note of is this is the point where you need to what optimize your investment. And this is exactly where first asset management comes in. So most people today, once they get into their 40s, they have investments, but unfortunately, the bulk of those investments are not necessarily optimized and maximized. So you need to employ the services of a sound professional asset manager that would guide you in how to rebalance your portfolio in ensuring that your investable funds are ultimately optimized. So that once you get to your 50s, your core focus now is still leaning on the guidance of that professional fund manager in what rebalancing those that your portfolio from high risk assets into what lower risk assets with the
Yeah.
ultimate aim of what preserving your capital for what your retirement needs. So I believe with all of these points I've stated, that just gives a roadmap as to how people should sort of strategize and plan towards wealth creation at different phases of their life from 20s to 30s to 40s, 50s, and ultimately 60s. But again, in summary, three key points are very essential. One is key priorities. Secondly, your key responsibilities. And thirdly, also identifying the time horizon that you have. That will ultimately shape your investment decisions.
Wow. 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 Thank you so much. I mean, at the beginning of this webinar, I told our attendees they're in for a treat. We've given them more than a treat. In fact, I've learned so much. I love the way you broke it down for people in their 20s, people in their 30s, people in their 40s, people in their 50s. And how, as much as the three key pillars for you is identifying your priorities, identifying your responsibilities, and your time horizon, is also ensuring they understand that it changes from your 20s to your 30s to your 40s to your 50s. Yeah. So your priorities will change, your responsibilities will change, even your time horizon will change. So it's for you as an individual to understand how this will change across different decades and how you should apply it to yourself in terms of your financial investment journey. Thank you so much, Jiggy. We're bringing it home slowly, slowly. We're almost there. But we've said so much today, and we've dropped so much gems, right? Now let's now hit the nail on the head. I'm going to be throwing this question to all our speakers. How would you recommend people create the future with their money today? We said so much, but how would you recommend people create the future with their money today? And let's have you go first.
Okay. And I noticed that quite a few people didn't join early. So I tried
Yeah.
to also refer to what I said before and mention that please the recordings will be available on our YouTube channel. So please don't worry if you missed anything. So how do you start today? The way to start is to begin the habit of putting money aside. Anytime you earn money, it can be 10%, which is fine because even if you start with 50,000 naira and you invest that consistently, because it's consistency that makes the difference. Let me clarify that. Consistently for 10 years, let me just say 15%, not even anything, 15%, you'd be able to earn almost 14 million in that period for people who can afford to put just 50,000 naira. So if you can
Wow.
multiply that as your earnings increase, imagine what compounding will do for you. So please, the first and most important thing is to start now and to start being consistent. Please, let's pay ourselves first and make sure that happens. then remember that this money you're keeping aside has to go into assets that can continue to give
Correct.
you
You can't
returns.
remain idle.
It
Yeah.
is critical that you put it in things that give you returns. I know a lot of us mix up they say, oh, I bought this asset. It's a no, if it's not giving you returns, it's not an asset. So please ensure that you put it in things that can give you returns. And I'll end with saying, as you start to gather that wealth, try to diversify into things that will beat inflation so that you're not losing money as you're holding it. And Gbolahan speaks a lot about the stock market. We have the balanced fund for people who just want to start not fully in equity, but with a bit of it. And we have the smart beta fund for
Beta
if you
fund.
want to go into. And I mean, say put all of your monies in there. Put a bit
Yeah.
of it so that the while it's risky, over time, because those are for your long-term investments, it would balance out the safer monies that you're keeping in like the money market or the fixed returns. So please start now, be consistent, start to beat inflation as you go on. Make sure you're earning from your assets. And I'd say finally, as you're protecting yourself from inflation, protect your assets as well. So if you can insure anything that can be insured, that would help you so that you don't lose the things that you've built up. So please let's just follow and don't forget to start today. I believe we've shared phone numbers. If you're not comfortable with phoning, we've shared an email address. We're
Yeah.
on all the social media platforms. There are so
Platforms.
many
Correct.
ways to reach us. So please
Yeah.
start, be consistent, and watch your money grow so that in the future you reach out to us and thank us. Thank you.
Thank you so much. And I mean, you've already informed the attendees of how they can reach out to us. But we'll still take that again at the end of the webinar. Thank you for sharing. I mean, Anne is very big on paying yourself first. I don't know what else we can use to motivate people again. Just pay yourself first, and every other thing else will follow. Thank you so much. And GB,
Yeah, thank you, Muyiwa. So for me, I would just highlight some of those key points I've mentioned earlier for the sake of late joiners as well. So as I stated earlier, you need to realize that building wealth does not necessarily mean that you need to deprive yourself of the essential things of life or living a low quality life. So it's all about finding that fine balance between what you spend at the end of the day and also ensuring that you have something at the end of the day to be able to channel into savings. Then secondly, remaining consistent with your savings pattern. So to do
yeah,
this, you need to be disciplined with your spending pattern and ensure that at every month, depending on the frequency you decide to, adopt, whether it's weekly or monthly or quarterly, you need to remain consistent. That is very, very important. Once you're able to achieve these two things, the next point is how should you then channel your savings into investment? Once again, this is where first asset management comes in. For me, I'm very obsessed with the stock market because I've seen how it has sort of transformed the wealth I've been able to accumulate over the past decade since I started investing in stocks in 2016. So I would say
yeah,
that for individuals who don't even have the luxury of time to say, you know what, you want to track the companies you invest in telcos, in banks, in the cement industry, in oil and gas. So you have so many listed companies in the stock market in Nigeria today. An easy way of gaining exposure to all of these profitable companies is what? By investing in either the first asset balance fund or the first asset smart beta equity fund. If you look at the
correct.
performances of this fund over the last 2 years, for balance fund, it did about 47% last year. Smart beta did north of 55%. This year, balance fund has done about 38%, smart beta at 33%. So you've seen,
Yeah,
very strong double digit returns across these funds over the last 2 years. So for me, I would
beating
say,
inflation.
irrespective of, the strata that you fall in, whether you're in your 20s, 30s, 40s, or 50s, I think to be able to optimize your investable funds and grow your wealth over time, you need to also be willing to take some level of risk, and that would require you to what? Have some exposure to high risk assets like stocks. And when you don't have the luxury of time, certainly these equity based mutual funds gives you that leeway to be able to gain exposure to stock market investing.
Thank you so much, Chibi. Tutu. So I'm trying, yes, please go ahead.
Missed everything again, but I'm guessing we're...
Oh, you missed my question.
No, it's fine. I think it's about the nuggets from today, right?
Yes,
so I'll just quickly summarize what I've said so far. And for me, is to remember that money is not a reward. Money is a tool. That every naira you earn is a choice. It can buy your comfort today, but you'll be trading away tomorrow's freedom, right? So choose to invest in yourself, which is very important and something I'm very passionate about. Choose to invest consistently, as Gbolahan has mentioned. Spend intentionally. Be realistic with your milestones, right?
Yeah.
Because at the end of the day, my understanding is true wealth isn't built overnight, right? It's built based on wise decisions that are taken one step at a time, right? So in closing for me, right, it's quite important to understand that you are able to capitalize and lean on the expertise of others as well, like my colleague have mentioned, right? And to close off for me is to say that at some point in our lives, right, your future will introduce itself to you. Just make sure that when the future introduces yourself to you, they are thanking you for the decisions that you made today. So while we listen to all of this, let us try and execute and implement, right? Don't just leave here inspired, leave here invested. I think that's the last thing I just want to add. And finally, again, my best word, money is not a reward, it's a tool. Thank you.
It's a tool, though. It's a tool. So many times I phrase it. I just try using all these things going forward. Thank you so much. I mean, we're running out of time, so we need to take as many questions as time permits. I'm running through the Q&A section, and the first question I have here, it will be directed to Tutu as well. An attendee would like to find out, aside our money market fund, our balance fund, do we have any fund that ethical investors can partake in, especially when it comes to the fact that for the money market fund, I mean, it has some level of interest river. So this attendee would like to find out if we have any funds that cater to ethical investors.
The answer to that question is yes, and thank you for bringing that up. I think Anne also mentioned that in the course of the presentation. It's called the First Halal Fund. It's a fund that invests in Sharia-compliant investments, and I'm sure when you plow the roads in Lagos, you see sukuk, some signboards here and there. So it's invested in some of those kind of investment structures. So it's a way of also giving back to the country. In terms of entry level, it's also a very good and affordable entry level. The fund is also been we have Sharia-compliant advisors that ensure that we comply with the jurisprudence of Islamic principles to ensure we align with those principles. I'm getting a Sharia-compliant certificate on a yearly basis just to ensure that we're actually investing those funds in line with Islamic beliefs, right? So in conclusion, we do have ethical funds, right, that you can actually see the impact every day as you move down the road. So we have those funds available, and the returns are also quite attractive as well. So the fact that you're investing in an ethical fund doesn't necessarily mean you need to part with your investment returns. The returns are also very, very exciting, and something that we're willing to introduce you to. Just speak to one of our relationship managers or drop your number on the call and we'll send you all the details required. Thank you.
Certainly, and if people, attendees have been dropping their contact details. I mean, we have over 1,000 attendees. I think it's the most I've ever seen, and I'm so happy. And they've stayed with us till the end. Let me take the next question. It's directed to Anne. An attendee is asking, what are the safe investments you have for passive income or for retirement planning?
Okay, so we have a variety of options, and passive income, well, I'd say that is more long term. And so I'd work from the fixed income to the equity because those are more potentially higher yielding long-term solutions. So with passive income, you can put that in a fixed income fund. We have the regular and we have the halal, which Tutu just described. Those are more like medium-term investments. Or, I mean, the halal has done north of 14% over this period in
Right?
profit and loss sharing, so to speak.
Yeah.
Or let me not say or, and you can also move on to the balanced and the specialized dollar fund. I mean, Gbolahan spoke about the juicy returns, 40%, north of 40%. And that I think those returns are the sort of things that you should use your passive long term. You're not using it for everyday goals type monies for, so that the monies you're using every day can earn lower returns, but overall your portfolio is beautiful. So please, I think details of our websites have been posted or email addresses. Please have a look at our equity-based fund, specialized, and also our dollar funds. I almost forgot. If you have
Yeah.
any kind of cash flows in dollars, school fees, holidays, whatever, it's best to just invest some of your monies in that currency as well. And our returns have
True.
been fantastic. Over the past 2 years, between 7 and 9% on FX
9%.
is really, really brilliant. And so
Yeah.
please invest in our dollar funds. We have the regular dollar, we have the specialized that invests in things like gold, and we have the new blended that we've done that is investing in all this IT stock that you're hearing about, AI stock, all of that in America. We invest in all of
Exactly.
that. So these
Yeah.
are fantastic things that you can put your monies in. My monies are there. So I'm not just talking. And I'm enjoying the benefits. Honestly, investing has changed my life. And it's not because I'm on this webinar, it's the truth. Thank
It's the
you.
truth. Thank you so much, and thank you for being a living testimony to First Asset Management mutual funds. GB, an attendee. So this question is coming in two parts, right? I just
Okay.
meant it because I feel like you're the best person that can attend to this. So an attendee would like to know in simple terms, what is our balance fund? And another attendee would like to know the difference between a portfolio and asset classes. So take it away.
Okay, so for our balance fund, it's essentially an equity-based fund that seeks to provide long-term capital growth to investors. So the word balance is coming from the fact that the fund aims to balance or mitigate against downside risk, because equities by nature it's a volatile asset class and it's also high risk in nature. So to mitigate that downside risk, the funds has exposure to fixed income assets such as, treasury bills, bonds, just to be able to mitigate, the downside risks stemming from exposure to equities. And in terms of performance, the performance of the fund has been quite strong for the past 2 years. Last year, the fund did 45%. This year, on a year-to-date basis, as of 15th of July, the fund is up by 38%. So very strong returns on balance fund for an investor who has a long-term investment horizon and does not have that, freedom or time to delegate
Yeah,
into monitoring
yeah,
exposures to various companies listed on the stock exchange. Now, in terms of a portfolio, we can also, design a portfolio, a bespoke portfolio that would suit, the key peculiarities of an investor. So whether you are low risk,
yeah.
medium risk or high risk.
Balanced
So a
or high
portfolio
risk,
can
yes.
be specifically curated, to suit, your investment horizon, your risk appetite, your financial goals and objectives. Then lastly, on asset classes, it can be broken down into fixed income, equities. On fixed income, you're looking at, short dated, instruments like commercial papers, treasury bills. And then if you increase your duration, you're looking at longer term fixed income products such as bonds, be it commercial, corporate bonds or federal government bonds. And lastly, you have, equities.
Hi, GB.
Can you hear me? Yes, I can still hear you.
Yes,
I
I
can still
can.
hear you.
Okay. Yes, okay. Thank you so much, GB. So in terms of the balance fund, basically anyone who is interested to exposure to equities, and you don't have time or
That
the
time, yeah.
expertise,
Time is money, but
just pass on the burden to us and invest in the balance fund. That's basically what GP is saying, right? Tutu, there's an attendee who is asking, what's the best investment available in foreign currency? I think this attendee is in the diaspora, and they would like to know what's the best available investment in foreign currency.
Okay, thank you for that question. The best investment available in foreign currencies is an investment in yourself. And that asks the question.
Again, Tutu,
Having
again.
said that, it's an investment in self, but don't mind me, I'm just being cheeky. So in terms of the product that we have in-house, it's the dollar products that we do offer in-house, like we've mentioned. We have products that lean on the fixed income side, like Bola was also alluded to, in terms of just investing in fixed assets. So they're not as risky as equity investments. So we have the specialized dollar fund and we have the dollar fund. And we've mentioned the returns 2023, 10, 2024, about 9%, and 2025, 8%. And this is in hard currency. When you compare that to what you get in the diaspora, they're not as attractive. The other option you have in terms of funds we have internally are the ones that are exposed to equities, like we mentioned, right? So diversifying across those two portfolios will give you inroads into the returns that you can get from those portfolios. So for First Asset Management at the moment, in terms of investments in currencies outside of Nigeria, we both have those with exposure to fixed income and also to equities. So that's what I would recommend. But an investment in self is also quite important. Thank you.
Thank you, Tutu. Anybody that's not started investing in themselves after the end of this webinar, you are wrong.
To me, but I mean, just to quickly add to what Tutu has said. So on
Yes,
the
please go
dollar
ahead.
side of
Yes.
things, right? We also have a fund that is quite unique. I mean, in the market, the blended dollar fund that seeks to also provide, I mean,
Yes,
exposure
yes. I
to
mean,
US
Anne
listed
mentioned it. Yeah.
equities.
Well, I
Yeah.
mentioned
So
it
today,
now. That's the equity
oh,
It's
let me
equities.
just, yeah.
Yeah.
I just
So
want to
please
Exactly.
go on.
reiterate again. Yeah.
you
It's
know
a
to
good
do an equities
opportunity. I get
Yeah,
it,
to
because I mean,
Bola. He
reiterate.
doesn't
there's
want
so
say he
Yes.
much
wants to
discussion
miss
today
it.
about the boom in the
Yeah.
AI space. So I mean, if you're
Yeah.
looking at
Yeah.
also gaining some indirect exposure to a fund that has the leeway to invest in US listed equities, then the blended dollar fund also gives you that, I mean, opportunity to gain exposure to US listed equities.
Yeah, also just wanted to, particularly because that space can be quite volatile, right? So if you're not in the
Yeah.
market every time, you're just best, like I mentioned, to lean on the expertise of others. And that's where we come in because that's our bread and butter. We eat it every single day. And we have the
True.
fiduciary responsibility to ensure that we are managing those funds in such a way that it optimizes return to the unit holders. Thank
True.
you.
Very, very true. Very, very true. Thank you so much for that. I'll take about 3 more questions, so one for each speaker. And I think someone's actually ready to invest in dollar funds already. This attendee would like to know if they need to have dollars at the moment. I mean, right now, if they want to invest in dollar fund, do they have to own dollars to start investing in dollar fund?
The answer is no. And so here at First Asset Management, we have used strategic partnerships to solve that problem for you. And so with your Naira, we can get our partners to convert your Naira to dollars and send them directly into your investment. And so you don't need to go through the hassle of trying to source dollars. It's about easy
True.
investing. That's why we're
True.
here. So bring your Naira. If you have dollars, no problem. But even if you bring Naira, once we convert it to dollars, your repayments and your returns would all be in dollars. So be
In
rest
dollars.
assured that,
Yeah.
yes, once it's moved to dollars, it stays in dollars. And thanks for your
Thank you.
interest. We look forward to
Yes.
onboarding you.
Yes, we're here. We're waiting. We're here. We're waiting.
So if I
GB.
can quickly add to that
Okay,
as
you
well.
want to add to that? Okay, please.
Also, we recommended these platforms as well. We have no say in whatever exchange rates that they use to convert your currencies, right? So we recommend those platforms, but we have no control over the exchange rate. And we're just introducing to you to someone that can actually get it.
Yeah, our
And
partner. Yeah.
to some extent, yes. Thank you.
Correct. Yes. We're basically just introducing us to our partner, our well-trusted partner, and well-vetted. GB, this question is for you. The attendee would like to know, I mean, for a business person, because we majorly commented around 9 to 5ers, right? For a business owner, they want to know which kind of investments can they start with in terms of their investment journey.
Yeah, so I mean, for a business person, you need to first of all, I mean, identify, I mean, your need really. I mean, what are you trying to achieve? So, are you looking at placing some of your liquidity on a short-term basis to be able to meet up with some short-term obligations as well? Or are you focused on the long term, in which case you want to put aside a specified sum of money to say financing a capital project in the medium to long term? So based on, those two scenarios, that is what would ultimately influence, the choice of investment outlets that you choose at the end of the day. But if you are focused on, a short-term approach, in which case you have excess liquidity, you want to put it on a short-term basis to earn some interest, then we have, short-term structured investments that you can put your funds in. If you also have funds that can sit with us for a long period of time, then you can also look at, the equity-based funds I've mentioned. If you also want to design, I think, a staff gratuity scheme for, say, your staff members, you contribute on a
Yeah.
monthly basis for the benefit of, the staff members, then we can also design a staff gratuity scheme, more like a bespoke portfolio to cater for, your staff members. So across your business needs, there are designated products that are designed to suit all of your needs.
Thank you so much. Mr. Business Owner, I hope this means you'll be calling us very soon. GP has broken down how you can begin your investment journey across different cycles. So we look forward to having you on board. The last question will be to Tutu. And the attendee would like to know what the difference is between our bond fund and our money market fund, and if there is or there are any advantages between one over the other.
Thank you so much for that question. I've also seen in the chat from some people don't really know what mutual funds are. This is why we're doing this, just to educate and empower people, because we're very, very, very passionate about financial literacy. So a mutual fund, quickly, is a fund that is regulated by SEC. So we ensure that everything we're doing is in compliance with the regulators. It's regulated by SEC. It has a trustee that ensures that we're investing in line with the objectives of the fund. Now, looking at this and making it a bit more relatable, a money market fund is a fund that you can liken to a savings account, in the sense that it's a fund that you put monies in where you're sure of capital preservation. And some of the assets you find in that portfolio are government-backed instruments, like treasury bills are in money market funds. You have credible CPs that are issued by very highly credible entities. That's what we invest in. And then also have investments with banks, very credible banks. So in a nutshell, you can liken a money market fund to your savings account that gives you very attractive returns, right? It's a fund that you can call on your money when you need it. It's a fund that you can automate and imbibe that consistency and habit required to get to your goal. So a money market fund, it's safe. Money's for your rent. Money's for like school fees, monies that you want to be sure of what you want to get at the end of the period without any sort of volatility is what you put in the money market fund. So safe investments are in the money market fund, liquid assets are in the money market fund, and it helps you to meet short-term objectives. Now, for the bond fund, it's like your risk tolerance needs to move slightly higher, because while the money market fund invests in instruments that are very liquid and short-term in nature, the bond fund takes it a step further by investing in assets that has a longer duration, right? So what kind of funds would you put in this kind of fund is what you asked me. It won't be something that is very short-term. It's something towards more long-term. So let's assume you want to send your child to uni, you want to start putting some money in there to ensure that it's growing a bit faster, depending on the interest rate environment. That fund will definitely be suitable for you. So money market fund, definitely short-term investments. Bond fund have bonds in that portfolio by the very name, bond fund. So a bond is an instrument that has a maturity of higher than, I'm going technical now, higher than 1 year, right? To that end, the duration of that portfolio is higher. But in layman terms, a money market fund can be likened to a savings account. It's very liquid, right? Very, very short-term planning. I want to pay rent. Maybe I've earned the right to buy myself a good thing. You put it in the money market fund, capital preservation. Bond fund is quite different because the assets in that portfolio are invested in longer-term instruments, like a 3-year, 5-year, 10-year, 20, 30-year instrument. So ideally, the rates should be attractive on that particular portfolio. So for that kind of investment, you put it towards more medium-term, right? Your time horizon is more in the medium term. So that's the key difference between the two. Thank you.
Thank you so much. And we are almost run out of time, but 30, in fact, 20 seconds from each speaker. Takeaways Tutu, you can go first since you just finished speaking.
I think I've already given that because I thought
Seconds.
I was we're giving, but honestly, I just want to thank everyone for coming on the call. It has really been an insightful session. I've learned so much from everybody, but at the end of the day, like I said, let's not just leave here inspired. You need to start today. You need to automate your investment, ensure that there's consistency, empower yourself. It's very, very important. And also lean on the expertise of others where you need to. And also seek knowledge. It just keeps giving and no one can take it from you. Thank you.
Thank you. GB.
Yeah, so I'll just close out with this popular saying that Rome was not built in a day. So your journey to wealth creation is not a sprint, it's a marathon. So you've got to start today, maintain a disciplined savings culture, and stay consistent through that journey, and you get to your ultimate destination.
Thank you. Anne?
Okay, so I'd end using the topic about your future. Your financial future, you don't find it, you fund it. So start today to be consistent in funding your future and let your money work for you towards achieving your goals. Please start today and be consistent. Thank you.
Thank you so much. And for me, to all our attendees, thank you so much again for joining. Don't just leave here informed, leave here invested. Reach out to your investment advisor today, open an account today, increase your contributions today. Your biggest risk is not inflation, is inaction. So start today. Thank you all for attending once again. The recording of this webinar will be available on all our on YouTube, actually, on YouTube at First Asset Management. That's management with MGT. And follow us on all our social media pages. We're on Instagram, we're on X, we're on Facebook at First Asset Management. That's First Asset MGT. And if you have any questions, inquiries, comments, you want to sign up, please send us an email. Talk to us at firstassetmanagement.com. So that's first-assetmanagementinfo.com. And we'll be very, 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 very happy to take on whatever questions, clarifications, and signing you up and getting you started as quickly as possible. Thank you all once again. Enjoy the rest of your day, and we'll be looking forward to hear from you very, very soon. Bye, everyone.
Bye.